You are live. Hello, good morning. It is Thursday, March 23rd, 2023. I'm Lex, and this is Traders Workshop. And we've got our great friends, Jason and Mark, on today. And we have a 25 basis points, another Fed deal. Let's talk about it. Hello, lads. Jason, wake up. How are you?
Oh, wait, I gotta.
What is this? Oh, we got another hat.
Yeah, I wore my
Same
hat today
hat.
because I didn't want to be all alone on the swag train.
Dang,
Or
swag
left off the
train.
swag train, I should say.
Looks good. Okay, there you go. There you go.
There you go.
Yeah, I can't see it. It's bleeding out, but that's good enough. All right, how are you guys? Good to see you. I can't say that a lot's happened in the last week. Well, I could say that. We could say that. So another 25 basis points. Jason and I were talking, Mark, before. Yesterday, the market got hammer-roonied after all this FOMC stuff. And Jason was saying that maybe it's because the FDIC, the insurance, Yellen said maybe it's going to stay at 250,000. Did you hear that too?
Yeah, my understanding, because the specific interest rate commentary was actually almost dovish.
Right.
I mean, relative to where we've been, but I agree that it felt, that was the walk he had to balance between the banking crisis and the inflation crisis. And it did feel like inflation, like I said, a little bit dovish in some of the commentary, but banking, no broad guarantees for everybody.
No, I kind of like it. I think 250 is good. I don't know. Jason and I were debating that earlier.
I just keep my money in 50 different banks. It's fine. It's not big.
That's right. You just hit 250 or 240 at 25 different places, and you're fine.
Yeah.
Wait, that's a lot of money. That's good. That's what the really rich people do. They have these ladders, right? 250.
I think there are services. There's like a fintech that'll do this for you. That'll like automatically chop up your bank accounts behind the scenes, do cash sweeps.
Is that right?
The name of it though.
Yeah.
All right, good. So I was in Irvine, California this past week at a summit. Talked about dealer hedging and what have you, and I did give Jason a plug while I was there. So, and Mark, I heard you logged into Voland. That's good. I haven't had a chance to because I've been traveling, but I'm going to do that hopefully this week.
I did. I've been poking around. Thank you, Jason.
Yeah.
You like it? Just wait a couple weeks. Voland Live will be. I guess it's about a month or so. Voland Live will be out.
What does that do for us? The live part. I mean, besides.
Voland Live. So right now, Voland updates once a day at 5:30 p.m. When we initially launched Voland, we were just kind of seeing if it was going to catch on, if the data, people understood the data, and there's a little bit of a learning curve to understanding the data unless you're a market maker. But we had a nice visualization. We used Google authentication, and it has caught on. A lot of people have subscribed. A lot of people enjoy it. We have a Discord feed that, we talk about, hey, what does this chart mean? And I kind of express things. So it has gone on. People like it, and people are valuing it quite a bit. There's a lot of profits being made in the page. So Voland Live, I mean, it takes a lot of compute and a lot of processing power and a lot of storage to calculate every single Oprah trade that's out there and calculate all the Greeks and aggregate them. I mean, we try to do this right. Mm-hmm. So Voland Live is basically upping the ante. Instead of updating once a day, we're going to have a couple of interim updates. And we were kind of tossing around timing, but maybe twice a day and maybe every hour. Mm-hmm. And then a very supreme kind of Voland Live, which would be updating every minute.
Every minute.
Wow.
Every minute. So what's great about that is it will include the zero DTE stuff. As zero DTE is trading, you'll see it, every minute updating. And the other thing too is we're developing better visualization, so you don't have to interpret the data so much; it gets interpreted for you into a candlestick chart. We're going to have VANA calculated with fixed price vol instead of kind of with assumptions around each equity's VIX.
Mm-hmm.
We are going to add to the equity list to try to make a component SPX.
Right.
I mean, we're upgrading quite a bit. We're also going to do a really cool vol plane visualization where it'll be 3D with a heat map, and the 3 dimensions are delta. So like, you know, at the 50 delta, at the 40 delta, 30 delta, etc. Maturity and implied volatility will be the Z-axis.
Mm-hmm.
And you're going to see the implied volatility across the whole vol plane on all 3 of those aspects at the same time.
Mm-hmm.
And then the heat map portion is going to compare it to what was yesterday's implied volatility. What was the historical volatility at those expirations, at those maturities?
Yep.
The skew implied vol, which we don't see out there, and that's something that I'd really like, which basically takes the correlation between the implied volatility and the spot price of the underlying and assumes a certain skew. And what is the skew of the implied volatility compared to that?
Interesting.
Yeah, so it's going to be, so there's going to be a lot of volatility kind of predictive tools that you're going to be able to use in order to try to predict VANA moves, which we're finding VANA is the primary driver most of the time for.
So why is that? So just for folks, give a quick definition of VANA first of all, and then tell us why you think the VANA, because you refer to VANA a lot on this segment. As being the key driver. Why do you think that is? First of all, what is VANA? Second of all,
right. So VANA, first of all, is, I mean, it is the cross derivative between the delta and the vega of an option. And what that means is it kind of has 2 definitions. It is how much does the vega of an option move with every move in the underlying, or how much does delta move with every move in implied volatility. And so the reason why that's important is because as implied volatility goes up or down, dealers book will hold delta will go up and down with it. And they have to hedge that in order to prevent, in order to remain risk neutral.
Okay.
The reason why I feel that and since I've launched Voland, since I've completed Voland, it's a whole team of people that do it. But since we've completed Voland, we've noticed that VANA has had more and more of an impact. And I think it's because options have been traded more and more. And implied volatility may not be completely, as we discussed on a prior show, it's not completely hedged like Delta is. Delta is a lot easier to hedge with the underlying, but Vega is not as easy to hedge because you have to get other options or swaps or VX futures. So because it's not quite hedged the same, moves in VANA, so like moves in implied volatility, have had a larger impact. And if you look over the past year and a half, Mark could probably tell you, we've noticed that a lot of moves down have not been accompanied with as large VIX moves. And moves up has not been accompanied as much by declining implied volatility in VIX. That's the most popular. SPX is the most popular VIX, index to see, to kind of see this on. So it doesn't take much implied volatility for markets to move, and that's a sign of strong positive VANA, particularly in zero data expiration.
So what happens then in a lower volatility environment? So clearly we've been moving around a lot, the market at large. Is what I mean. Does VANA have less of an impact in lower volatility markets when VIX is like 12, 14, and then Charm takes over?
So in a lower volatility, I think Gamma has a more Gamma ends up having a more a larger impact, and the reason why is implied volatility. The options are inherently cheaper. And so there's less buffer with volatility in each purchase or sale of an option that can allow the market to move very much. So implied volatility comes down. Historical volatility also comes down, but then there's like a gamma points that become accelerants.
Okay.
And,
Yeah. Okay. I got it. So Mark, do you think the market maker shops of today are actually quantifying Vanna and Charm, or is it?
That's a good question. Not
really happening? Or are they doing it intuitively like you and I did back in the day? I didn't know what Vanna and Charm was when I traded. That's a term I would never know.
I think it probably really depends on the type of trading style you're going to do, right? Like, I think there are definitely market makers that are much more on the quant end of the spectrum, that are certainly managing their Vanna. And, to the extent that you have, maybe not necessarily as a dealer, but like as an institutional trader managing a vol strategy, you're going to be very concerned with Vanna. If you're trading an index, you're probably more concerned with Vanna than if you're trading a pharmaceutical stock. So I think it probably depends on both like your style. There are definitely the more manual people still out there. And I think names that are kind of lower down the spectrum don't have a bajillion different strikes and expirations and whatnot, that's where you're going to be managing it sort of much more by feel and synthetics and, those types of relationships rather than quantifying your Greek exposure, your, granular Greek exposure.
Yeah. So that's good points. I think, here's how we did it in the old days. On Friday, we moved our date ahead to Saturday by about 10. Then we moved it to Sunday by about 1:30. And then we moved it to Monday morning by 3 o'clock, right? So as you move time ahead, that takes into account Charm, right? So we're theta-izing the deltas by moving ahead. So we knew that existed. We didn't know what it was called though, right?
Now it's all done automatically, but we had the exact same thing. We literally had a knob called days ahead.
Yeah,
right. Tick that up throughout the day on Friday.
Right. That's how we did it. And then for volatility, that was easy. Just take the volatility plus button, go see what your position looks like, and then hit the minus button, see what it looks like, and call it a day. And we said, interesting. But we didn't know it was called Vanna. Now guys like Crazy Jason over here, he puts this system together. We can do it. He can do it for us. I love it, especially the minute by minute one. I like that one. So
for sure,
it's good for the day trader.
Yeah.
Sorry,
about the options being relatively cheap. Bloomberg had another article out yesterday about the zero DTEs, and they had a couple of interesting charts. I think they were put together by Bank of America, showing that the VRP of zero DTEs has actually been trending upwards. So the volatility risk premium as measured by the implied volatility of zero DTEs relative to their realized volatility. And of course that like swings around a bunch, but like over, I think they were using like a 30-day average, that it continues to actually tick up, which is, people pricing in a little extra juice for the movements, right? Like,
well, so that's interesting because that's being priced by the market making community who has to take the other side of all these zero DTE trades, right? So they're pricing in this extra risk premium because I'm guessing that what are they? Well, I would think they'd be long it all the time. I think the retail public would tend to sell that stuff.
I honestly think it's a mixed bag. I think there are a lot of like long shot buyers. You buy the nickel or dime option, betting on like a big move. I really think it goes both ways. I don't have like specific numbers, but anecdotally, what I hear, I think people are trading both ways. Yeah.
So the zero DTE thing too. I've been traveling a lot and speaking at various parts of the country now, and everyone. That's one of the first questions that comes out. They want to know about zero DTE. Everyone's asking about it. I mean, again, don't forget the community is retail community, which is it's great. I love the fact that they're interested in that. So very, very popular product. I'm interested to see if they start releasing these in name specific stocks, Apple, Netflix, and start doing zero DTEs there, which I think is coming. I mean, I think it's probably could come.
Yeah,
and look at the rollout of weeklies.
What'd you say, Jason? Sorry, Mark.
Oh no, I was just saying it's got to be around the corner. The funny thing too is when you read just kind of, in financial news and financial literature about zero DTE, there does not seem to be any agreement on who is buying these, who's trading them, what position are people having, is it going to cause a massive sell off, what's going to happen. I think, and the other thing is, how do you measure what these things are? I mean, it's been varied, and really there's been a lot of kind of bad information out there about 0DT, who's trading it and things like that. So I think it's pretty, it is something that people though are interested in. So I actually have a form here that I wanted to, if I could share my screen.
Sure, please go ahead.
I'm wondering if this is going to be, if this is going to jog some memory.
Okay.
For you guys.
I hope you're not counting on my memory to be jogged.
While you're pulling that up, I'll answer your question. I think everyone's trading them. I think it's institutions. I think it's retail. Yeah. I think people are secretly trading them in their PAs in the bathroom from big banks. I think that literally anyone who's in options is messing around with these. And to address the point about what could happen because of them, I think it's exacerbating market movements, no doubt, right?
Yeah, I think you're right, Mark. I agree with that.
It's pushing them around. I don't buy the whole Volmageddon's going to happen because of these, or that they're going to institute a massive sell-off. I think dealers are pretty good at managing that kind of risk. It's wiped off the book at the end of the day. Something like only 6% of them are held to expiration even.
Is that right?
They're just popping in and out of these. Whoever, everyone is popping in and out of these. But and it might buck the market around more, but I don't think it's, we're sitting on any kind of ticking time bomb here other than a little bit more volatility.
Yeah, I think that's probably right too. Jason, what do you have on the screen that I cannot see? That's because it's so small.
Okay, I'll zoom in.
Okay, zoom in. Oh my God, there's so many numbers. I can't even look. What is this?
Well, this is a sheet that market makers apparently at the end of the day had to fill out in order to, that the computers fill out for you in order to see what your book is doing at any given time. If
okay. So this is
12%.
Yeah. So this is a risk profile of a complete portfolio of some market maker company, right? Of XYZ. Let me look at it real quick.
We used to call this a stripe, that it would have your Greeks at various different shock points.
Yep, that's right. Well, so and that's how they
delta shock points.
Yeah, and that's how they do portfolio margins still too, right? So they take, I forget the numbers now. Is it 5, 15, 30 or something like that, or 20, 30, and they shock your portfolio in portfolio margin. This is the simple view, and they come up with the worst scenario of any one of those points, up or down. That's your haircut, right? Remember that, Mark?
I think they do 2 dimensions, right? I think they shock. It's like a matrix that they create, that they shock on vol and on.
That's correct. They do.
Price.
They do. Absolutely. And I think they can do vol up and down too. I think
agreed. Yes.
30% rise in vol, and I can't remember the downside component, but they do all these permutations and they pick the worst value. And if you don't have a worst value, you make money everywhere because you're long premium. You get $25 a contract.
Right.
Right. So, we had that issue when Amazon and Tesla split 5 for 1. All these market maker firms who might not have risk now have 5 times the portfolio, and they have to pay $25 5 times more, right? So they're freaking out back then. Well, they got through it, obviously, but little scary. All right, sorry, Jason. So this is very similar to what I'm used to in the old days, right?
Right. I mean, but it's kind of more comprehensive, and they're showing up. Vanna, Volga.
Yeah.
Here's
what is Volga?
Volga is to Vega as gamma is to delta. It's basically the acceleration of Vega as price moves up and down.
Oh my God, Mark, are we gonna have to go back to school on this? What the heck is that Volga? I thought it was like a Russian gymnast or something like that. I mean, unbelievable. Volga, you're making this stuff up.
Well, we are making it up, but
Well, thank God it's 0 on this board.
We're calling it.
All right. What's OEV?
I think it's option earn value. I'm actually not quite sure.
I think it's options equivalent value.
Okay.
I think it's like converting your whole book into straddles.
Oh, okay. That's interesting too. I want to break this down, not here, but at another time and get back to this. So where did you get this from, Jason? What is this? Is this yours?
I got it from one of Mark's friends actually a long time ago.
Got it. Got it.
No, it's Nick. Nick gave this to me.
Interesting.
Oh, no kidding. Okay.
Yeah.
I thought you were being sarcastic. No, Nick, he said it is one of my friends.
Someone on September 16th down there below, someone's long a lot of puts. No?
Yeah.
8 million to the downside. Oh, I see. They go in another expiration. Okay, I got it.
Yeah.
Got it.
But
cool.
Yeah.
I like it.
But yeah, I mean, it's kind of cool.
Yeah, no, it's good. I think so the retail person though, right, isn't going to have a book like that. So they typically have very specific, iron condors, butterflies, whatever they do, and they manage them as independent little pieces, right? So they tend not to. I don't see a lot of folks aggregating their portfolio exposure. I hardly ever do, right? They're very stock specific, and they have specific things on directional or non-directional for that matter, if they're trying to collect harvest premium. Yeah, I see a ton of that, and that's why I think they're very interested in the market maker behavior, because they don't understand it, and they want to know how it affects their inventory, which is a great component, a great question. So,
yeah, I think really what the retail investor is doing is they are making thesis that they understand. So, if they could say Apple is going to fall because iPhone sales are going to fall, or, there's some revolt in China and, something like that. And they think, okay, so Apple's going to fall. There's a lot of presumption in there about liquidity is going to be, satisfactory, that the price as it is reflecting everything that is fundamental within Apple and liquidity wise within Apple. And I think when you the thing I think Voland does is it introduces a certain liquidity component to people's thesis, where they could say, I think Apple's going to go down, but how many people are behind me with this? Are dealers helping me? Are our dealers hurting me? And I focus on the option dealers because, number one, option volume has gone so far up in recent years that market makers are the tail wagging the dog a little bit. Number two, they are price insensitive. So because they don't care necessarily what the price of the underlying is, as long as their book is the book risk is managed. So you could if we can kind of see what they have to do in order to manage the risk in their book, then we can make a thesis on short term or even moderate term price movements. And number three, because of the Oprah order book and all the laws that came out after the global financial crisis, you could see the orders coming through with options a lot more. It's a lot more what's the word, transparent than it is when you're looking, where's Goldman buying equities? That's kind of hard. There's dark pools. There's, multiple, level two. There's spoofing in liquidity, and even in futures. There's so I mean, there's a lot of opaque orders out there in the equity side, but in the option side, it could be a little bit clearer if you know where to look. And that's really what the mission of Voland is for the retail trader. It's to present that data in a concise way. And we're still improving, but I think that's what we're trying to do.
Yeah, I like it. I like the levels in Voland. I typically like the SPX ones because I'm more market sensitive. So speaking of which, do we have levels? Do we have some gamma clusters we should kind of peek at real quick before we leave?
Yeah, sure.
And then Mark, for you, guess what I've been doing lately? Every big gap move in the market, I try to fade.
Okay.
Don't ask me why, and don't say that's so scientific. It's genius. It isn't, but it's been unbelievable. It's a call spread, a call credit spread when it gaps higher, or it's a put credit spread when it gaps lower. And I pick either diamonds or QQQs depending on my mood that day.
if it gaps lower, you should put on a risk reversal to get your deltas, short put, long call, because then you get the skew that's jacked up when we're down too. So you get an extra little cushion.
Yeah, while Jason's pulling his stuff up, how is Skew, by the way? You mentioned that pre-show about Skew. Are we steeper?
Yeah, actually, the interesting thing that we've seen with Skew recently is that the 30 and 90-day Skew levels are converging to be approximately the same. And typically you'd expect a longer out Skew to have a higher ratio of put to call, right? Same vol Skew is going to create greater price differential further out in time.
Yep.
But the Skew is so jacked short term that, it's not as much in the back term, in the 90-day term, that they're actually relatively close to the same price.
Oh, wow.
So if you want to do a little Skew lock or Skew arb, you can get long the back month Skew and short the front month Skew.
So long meaning buying put, selling call?
Correct.
Okay. Yep. Okay. Perfect. And you like to look at that 25 delta option, right? Thereabouts?
On the Skew, I look at the 15.
Okay, 15. Got it.
Because 15 is sort of that like peak Vanna range. That's, from like a trading perspective and from like managing that as a strategy, that's like a nice level to have on that you're not kind of getting crazy with.
Yeah, I just realized that my sweater matches my carpet, sort of.
Oh, jeez.
God, look at it's like everything. I didn't.
You're such an old man.
I know. Wait, I got my robe right behind me. I'll put on after this. All right.
Your sweater matches your carpet.
It does match my carpet. What are we looking at here?
All right. Are you got
Yeah, no, we're on
sharing Voland now?
Yeah, we can see it.
So here we are at March 23rd.
Yep.
March 31st is the end of the quarter, and end of the quarter typically means that we have a JPM basically collar that we have to deal with. The
JPM Morgan Stanley or that JPM.
Yeah, so JP Morgan, not Morgan Stanley. JP Morgan has a very large fund. What do they call it, Mark? The
hedged equity.
Hedged equity. And basically they are all long. It's a long only portfolio, but they sell a call and buy a put spread. They do Mark's Siegel in order to hedge in order to hedge their long only portfolio. But it has so much AUM in it that the size of the option position reaches, like 40,000 options in SPX, which is an obscene amount of notional. And you could see it poking out here. This is the short call strike at 40.65 positive Vanna. This is the long put strike at 34.50. And then the short put strike is, way down here. It's not noticeable. It's too far out of the money. Because of all this long Vanna here that is expiring at the end of March, I have been pretty vocal in saying we're probably going to rally a little bit. At times, these options typically are not very, they're kind of in the noise. You could see them. They are, it's showing up, but they're kind of in the noise. But April options, and further, like once March 31st goes away, you could see that a lot of this has gone up over the past day, but you can see Vanna has definitely declined. You see JPM is gone, that hedged equity fund option is gone. And all you could see from the banking crisis is all these deep out of the money options that are in May, September. Somebody went crazy and they bought a ton of September 2500 SPX options. And you can see that Vanna all the way down here.
Right. Interesting.
So basically what I think is going to happen, because there's no Vanna even near the money 3 weeks out from April, we might see some volatility, some dipping. You see a lot of negative Vanna up here, and that's kind of the primary position is somewhat long calls. that are way out of the money up here at 4,500 and over here at 4,300. So I kind of think we might see a drop after March. It doesn't necessarily mean we're going to be pushed bearish. But it won't take a lot. It'll take a small catalyst, and the next thing you know,
won't they roll this?
The market
they're going to roll this JPM thing, right? So it's going to be reestablished in the next quarter.
Yeah, it'll be rolled into June, but 3 months out, you won't notice the gains as predominantly as you would, 1 week out.
Gotcha. Okay, interesting.
The vol environment's making that an interesting role this time, right? Like one of the things I track is like how far out of the money are they going to sell that call, and they're actually going to be able, I think when they reset at the end of December, it was on the order of like 5.5%, 6% out of the money, whereas now we're looking at closer to like 6.5% out of the money.
Wow.
And that's because that put spread has gotten cheaper, meaning you can sell a cheaper, further out of the money call. But that's cheaper because the leg you're selling is more expensive because the skew is so steep on the downside.
Yeah.
Interesting. Okay. Very good. Very good. I love it. I love it. I gotta log into Voland today.
You got to do it.
I've got to do it. I like the levels. I love the levels. That's my favorite. So, all right, lads. Good to talk to you as always. As a note, Jason, you're going to be at the OIC, right?
I'll be there.
Guess what? I got invited to speak on a panel. Holy cow! You got to stay for that. It's Friday though.
I will. It's Friday.
Yeah,
I'll be there. I don't know about if I'll be sober, but I'll be there.
You'll be sober. Maybe I won't.
Yeah, I'll probably be sober.
And they didn't even tell me what the topic is. How good is that?
I was just going to ask, what's the topic?
I don't know. Market trends. And I said, look, I don't do trends, but
trends.
I can do options trends. And they said, don't worry about it. You'll be fine.
You can't get more vague than market trends.
I know, right? I'll show you a market trend. This sweater is a market trend right here. Yeah. Oh my God. All right, guys. Good to see you as always. I love the Voland thing. Can't wait to get into it. What else? Oh, well, I didn't do the market, did I? Shoot. Oh, Dow's up 243, Nasdaq up $190. Spoos. Almost getting toward 4,000, Jason.
4065 seems to be the magnet.
Okay. All right. I want to see
a week.
Gotcha. All right, guys. We'll talk. Have a great rest of the week, and we'll see you next week.
Happy trading.
Happy trading.
Take it easy.